Hello, everyone. Today on the Final Bar, we'll debrief on today's price action here on Monday, April 18th. I was off all last week, so I had some time this morning to review all of the long-term charts and see how they've evolved. Certainly giving back some of the gains recently. Today, really a choppy day with the S&P toying around that 4,400 level. What are those key levels we want to pay attention to with the S&P now that it's retesting some potential areas of support? We'll also break down some of the individual names and earnings this week. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical analysis toolkit, using the power of StockCharts.com to better understand investor behavior, better quantify trend and momentum, breadth and sentiment, all those concepts we talk about on the show. We had all last week off, which was really good. I actually did not look at the markets at all last week, which was very difficult, but super, actually a nice break. But coming back to things, there's so much happening. I almost wish I would have been looking at the markets. There's so many competing themes to pay attention to. At the end of the day, we have to rely on price, and that's what's most important to follow. That's why on the show, we tend to focus on signals related to price action, right? What's working, what's not, what's breaking out, what's breaking down. When you look at the action in the S&P 500, when you look at the FANG stocks, when you look at what I call the chart, which is a measure of some of those broad measures like the relative performance of utilities and semiconductors, certainly leaning much more risk off after a week away as I'm reviewing some of those charts. Semiconductors in particular showing some renewed signs of weakness. And out of all the FANG stocks, only one of them, Apple, is actually remaining above its 200-day moving average. So overall, you're seeing this sort of structural decline here. The rally that you saw in a couple of weeks ago really starting to fizzle off here. Let's look at the schedule coming up this week. We have three really good guests to help us make sense of things. Tomorrow, on Tuesday the 19th, we have Jesse Felder from the Felder Report. On Wednesday the 20th, Javed Mirza, who's the technical analyst at Canaccord Genuity in Toronto. On Thursday, Mr. Macro, Tony Dwyer from Dwyer Strategy is going to be joining us on the show once again. Let's continue on today's show with our market recap. Let's look at what's happened today. Again, I'm going to pepper in just some of the takeaways looking at the last week as well, because we didn't have a chance to debrief on things. Just looking at what happened today, the S&P was literally an unch. It was an unchanged day, essentially flat from yesterday, closing right around 43.92. Now, that only happened because of a quick rally going into the close. Overall, we were at the lower end of the range for the day just about 20, 30 minutes ago. The NASDAQ down as well. And for the most of the day, the S&P led the NASDAQ, but both of them essentially flat for the day. Mid caps and small caps down a little bit more on both sides. The VIX is actually settled in the low 20s, currently around 2230. Interest rates pushed higher. And again, I didn't have to look at the charts for the last week to assume that was going to happen. The general theme we've been talking about on the show for months now is this prospect of higher interest rates, all the ripple effects that can tell us, what that means about small caps versus large cap, what that means about value versus growth, the financial sector in general, and what sort of themes are most likely to emerge, or where we see those tailwinds that we want to take advantage of. So not surprising to see the 10-year yield actually nearing that 3% level. 10-year and 30-year yields are actually not too far apart, both nearing that 3% level. The dollar index today up about 0.4%. That's using the UUP. Now, gold and silver were up today, although they gave back a lot of early gains through the course of the trading day. Commodities continuing to push higher. And I'm looking at a chart of the DBC, which we'll get to here in a few moments, if I can remember to do so. Pretty elevated. If you look at where the commodity index is, and whatever index you're using to measure broad commodity strength, pretty strong. The energy sector, by most measures, fairly extended, and we've been talking about that theme. The question is, when do you see some sort of meaningful pullback in those areas of the market which actually have been showing consistent strength, while the S&P, the NASDAQ have actually been struggling. Cryptocurrencies showing some weakness recently, but really pushing higher in the last couple hours, with Bitcoin currently just below 41,000, Ethereum toying right around that 3,000 level. And big round numbers often are important for a lot of asset classes, but particularly cryptocurrencies. We've talked about the meaningful points where it tends to test and retest big round numbers. So 3,000 is currently a key level to pay attention to for Ether prices. Let's look, and I just wanted to mention very quickly, just because we didn't have a show last Friday to update you, but our market trend model, where we track the market on 3 different timeframes, turned negative last Friday on the medium term and the short term. Now, the medium term model for me had turned positive sort of late March, just on that bounce. And then 2 weeks later here, 3 weeks later, it looks like turning negative. So just spent 2 weeks above the zero line and now turning right back below. And in the shows we had there, and I know talking to my premium members of Market Misbehavior, we talk about how, yes, the model has turned positive on all timeframes, but I am super disagreeing with the model. And here's why. And we talked about some of the signs of internal weakness, some of those signs of challenge, looking at broad market measures, while individual stocks and certain ones like energy, materials, and others have shown consistent strength, and I think could continue to do very, very well. So as a stock picker, I think there continue to be very, very good opportunities. In terms of the broad indexes, the trend models actually turned back to overall fairly negative here. The long-term model has remained positive for me for about 2 years now. The medium-term model on Friday back to bearish. The short-term model back to bearish as well. So now I'm back to that pattern that we saw through much of this year, which is short-term and medium-term negative, long-term positive, which is pretty much how this market feels to me right now. Now, looking at a chart of the S&P 500, a couple things to talk about. We talked about when the S&P finally regained its 50-day moving average, broke above 4,600, which are the highs from February. Pretty meaningful breakout. But if you look, that gap higher was the move. And the previous week, not last week, but the week before, last time we did a live show, we talked about how the market had repelled that attempt to break above 4,600. If you look at what's happened in the last now 6 trading sessions since that, we've seen continued, and sorry, we had the holiday on Friday, but overall we're seeing continued weakness. In this tactical time frame, you're seeing lower lows and lower highs. And now we're at a pretty meaningful level here, which is the 38.2% retracement level. If you take the high from the beginning of January, take the low from the end of February, 38.2% of the way up is around 4380. That's where we found resistance back in March, beginning of March of this year. That was that first big thrust off of the lows, just about 4100. From there, we retested the lows essentially, then broke above there. And here is when we broke above trendline resistance, broke above Fibonacci resistance, really signaled some strength, which again materialized to another couple hundred points in the S&P, getting up above 4600. From there, we're now retesting that same Fibonacci level. So if 4375, we'll call it, holds, then this Fibonacci level continues to be support. We expect some short-term rally. If it breaks, though, I think that sends us down at least to 4,200, which would be that larger Fibonacci level going back to the March 2020 low. And I think most likely we fail to hold support and we go down there. But first things first, we need to break below 4,375. And that's a key level to watch. What's interesting this week, a little later in the show, we'll do a segment shifting stocks where we'll talk about some of the individual names, a ton of earnings this week. So there are no shortage of potential catalysts that could drive the indexes further to the downside. Just looking quickly here with another minute or two at some of the other major asset classes. I mentioned commodities being in a pretty good run. This is the DBC, which is one of the commodity ETFs we've tracked. We talk about crude oil, we've talked about gold, and some of the strength obviously we've seen, and the energy sector certainly has been the strength in the equity space in 2022. But if you look at commodities, they've had an exceptionally strong run. What interests me on this chart of the DBC is what I would call a pennant pattern. That's where you have a big run higher. You then have this consolidation of lower highs and higher lows. A lot of times after there's a big run in an asset class, you'll find the range start to narrow. You'll find lower highs, higher lows as we come together around an equilibrium price, which is around 26.50. From there, this pattern has resolved to the upside. And we know because it's broken above the upper end of that range. Now, what that usually means is you take the move up into that pattern, which was from around 19 to around 25 24, 50, 25, we'll call it. 19 to 25 is about 6 points. If you project that from the top, that says the DBC goes to around 33 as a minimum measurement, which is well above the current levels. That's why I think you could continue to see strength in the commodity area, particularly the DBC is what we looked at, the CRB index, the GSG, GCC. Those are the other ETFs that we use to track the broader commodity complex. Interest rates have gone higher. We've talked about the prospect of that. I'm not surprised. Reviewing the charts this morning again for the first time in about a week that rates have continued to push higher. And again, what that generally means is strength for value stocks, weakness for growth stocks. Generally speaking, now it doesn't tell you that growth stocks can't work and individual names can work very, very well. But when you look at the relative performance of semiconductors, when I look at the weakness in the FANG stocks, when I look at the strength in areas like materials and others, that makes sense given the rate environment that we're seeing. And if you assume that prospect of higher rates is going to continue to play out, that should be the general trend to expect. If growth would outperform in this environment, that would be a very different reality than we've usually seen when rates are pushing ever to the upside. Our next segment is called Sector Setups. We've talked about the big picture. We didn't get to cryptocurrencies, but I'd encourage you to look at the chart of Bitcoin, identify some of those key levels, Ether as well, right around 3,000. But let's look at the 11 S&P sectors using the RRG. I was chatting with Julius de Kempener earlier this evening for him in the Netherlands. We were talking about the rotation of different sectors. And what's interesting on the weekly RRG is the energy by far still the strongest performer. Now it's going due south. What basically that means, the fact that it's furthest to the right by far means it's been the strongest sector. The fact that it's going due south tells you that the momentum is drying up, right? Its strength of that outperformance is actually lightening up. However, it's still the strongest sector by the fact that it's furthest to the right. What's intriguing me more than energy, though, is utilities. And when I'm looking at the overall configuration of these sectors, I'm seeing continued strength in fairly defensive sectors like utilities, like real estate. Now, you'll also see some others like materials and healthcare and even consumer staples potentially turning up here in the last week. These are potentially the areas of opportunity. This is where you've seen emerging strength and now continued push to the upside. That movement in utilities is an important area to watch, not just for potential allocation, right? Not just because utilities could be an interesting place to rotate to, but also what it tells you about the overall environment. If utilities are continuing to do well, that suggests that investors are getting defensive and going to the relative safety of a low volatility sector, higher yielding sector like utilities. This kind of environment tells you that more of a risk off feel. The other area of the RRG to watch, two other points that I would point out. The others would be these growthy sectors like technology, which is actually rotated to the left, heading due west now, which is not a good look in the lagging quadrant heading west. That tells you that the underperformance is really pressing on. It's continuing. Consumer discretionary and communication services furthest to the left, but rotating north. So sort of the opposite of what you've seen with energy. So the risk to this idea of value and defensives over growth is that energy continues to go down, but starts to rotate into the weakening quadrant and head southwest. These growthy sectors actually head northeast, which tells you not just is the momentum lightening up, but you're actually starting to see more of a rotation. Now, we've seen obviously plenty of weakness in some of those sectors recently, and so I think there would be a lot that would need to happen for these sectors to rotate in a position of strength. But that's what I would be looking for here. The last thing would be the financial sector, the only one in the weakening quadrant, the only one really clearly heading southwest right now is the financial sector. And we've talked about, even though rates are increasing, the yield curve really, has been recently inverted. The yield curve overall is not in an ideal setup for banks, generally speaking. And you've seen the financial sector struggle. What's interesting about that this week is you have a lot of earnings this week. We're going to look at the charts of BAC or Schwab, which are both earnings names from earlier today. But later this week, we have others like, Fifth Third, like Travelers, NASDAQ. A number of financial stocks are actually reporting this week. So a number of charts to pay attention to see how earnings actually could provide some further strength or weakness for that sector. Just today, we'll see how some of those names have had very different reactions to their earnings reports. Just to finish off, let's look at the 11 S&P sectors on the candle glance function. This is a really good way to take a group of ETFs or group of stocks, sort of lay them out in front of you on a view and see how they look relative to one another. So my first question, when you look at these 12 chart. So it's the 11 S&P sectors and then the S&P on the bottom right. Which ones of these, or how many of these sectors are above two upward sloping moving averages? Which of these sectors are above their 50-day and above their 200-day? Which ones are in an uptrend using that as the basic definition? Starting from the upper left, consumer staples, healthcare, energy, materials, utilities, and real estate. Those are the only ones that are actually in an uptrend. If you define an uptrend as being above two upward sloping moving averages, and certainly energy appears to me to be the outlier. Although utilities, similar to energy, in a pretty strong uptrend, and again coming off of all-time highs in both cases. Now, which of those sectors on the opposite? Which sectors are below both of their moving averages? You have communication services, which we've talked about for some time, being clearly the weakest sector of the 11, I think, from a technical perspective. And I think that continues to this day, back below a downward sloping 50-day moving average. Consumer discretionary is actually right at the 50-day, but at this point, technically below both of those. The financial sector, which we mentioned earlier, industrials, and technology. So sort of those growthy things, and then throw financials in the mix as well. These are the, and industrials, these are the sectors that are struggling quite a bit. So you really have this differentiation between what's working and what's not. You have sectors that are at or near all-time highs, sectors that are breaking out, that are well above their highs from earlier in 2022. Look at utilities, look at consumer staples, look at energy, all well above their highs from earlier this year. Healthcare is one that actually attempted to break out, but failed. And that's a dangerous one to watch. We talked recently about the healthcare sector, some of the emerging strength in some of those areas like medical supplies, medical equipment, even some pharma names. But you're seeing in the short term some weakness coming off of those all-time highs. Now, on the other side, you're seeing some real weakness in areas like technology, in areas like communication services. And those are some of the names we're going to look at after the break, particularly semiconductors, which are struggling. Let's take a quick break. We'll be back with my next segment, Shifting Stocks. Hey, everyone. It's so good to be back with you here on the Final Bar. I'm Dave Keller here at StockCharts.com. We appreciate you so much tuning into our show every weekday after the close. Also, we appreciate you sending us your questions. As a reminder, all of our questions in our mailbag segment, which will be on tomorrow's show, come from you, our viewers. So email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours on the air on Tuesday's show. Also, as a reminder, go to StockChartsTV.com. All of our previous discussions, fantastic guest interviews, and also special events like The Pitch, our upcoming Stock Charts draft, which is coming up next week, and so much great content on demand for free at StockChartsTV.com, or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on with our next segment. We talked about the macro environment, the big picture. We talked about sectors and some of this rotation, this renewed strength from value areas of the market and weakness in growth. Now let's talk about individual stocks, and we're going to continue on that discussion of weaker growth, particularly in technology. And I was asked a lot recently about the semiconductor group. And you know what struck me, and again, it's great. I would encourage you, if you have not taken a vacation in a while, get away from the markets, park things in reasonable places, and just get away for a little bit, because looking at the market with fresh eyes today has been a really interesting experience. And a lot of, I've been taking notes at what's jumped out at me, taking a fresh perspective on some of these charts. And the first thing I jotted down when I brought up this chart of the SMH earlier today was head and shoulders top, right? And it almost jumped off of the page of me. Looking at some of these charts day to day and keeping track of them even intraday, you sort of have a rhythm of how they're evolving, and you really keep close contact. But taking another look, I'm struck by the fact that the high in November and December has now settled into a pattern of lower highs. So, technically, I think a technical analysis textbook would call this what's called a complex head and shoulders. That's when you have a high surrounded by lower highs, but instead of a really clear head and then a left shoulder and a right shoulder. You sort of have multiple shoulders. In this case, you actually have multiple heads. You have this double top formation in November, and then again in December to January. You have a series of peaks that are at a similar level here on the left shoulder. On the right shoulder, same sort of thing. What all of that adds up to is the neckline is pretty clearly defined here. And I didn't add it on the chart here yet, so I'm going to put it on here now. Let me pop this on here. So if we take the interim low there, we take the lows there. I think that's the best estimate of where I would put the neckline, assuming this is a complex head and shoulders pattern. What that tells you is if the SMH gets below that level, that would indicate a continued move to the downside. And generally take the height of this pattern, which is this whole area, and you project that further to the downside, which would take me around, again, quickly visually down around 180. What's also very interesting about that is how well it lines up with these Fibonacci support levels. You have this 38.2% level. You take the March 2020 low, the December 2021, high. You take 38.2% away. That's right here, just around 234. We'll call it 233. That would be right around this neckline and not too far below today's low, and really the low from last Friday, not too low below March low as well, around 235. We get below those points, and that suggests a further move to the downside, taking us down all the way to 180. That would get us down to the levels we were at in November of 2020. That takes us down to that consolidation phase that the market had after those first moves out of the March 2020 low. You had a run up to September, October, big consolidation pattern for the S&P and the NASDAQ. And so we're very close on some of these growth charts. Again, they've rotated back down, attempted to get above 280, attempted to get above the 200-day, failed here, and now back retesting the lows for the year. We're very close from signaling what I would suggest is a clear indication of much further downside potential for semiconductors. And again, when I'm thinking of the broader markets, semiconductor index breaking down through key support with a lot of daylight down to a potential next support level. It doesn't make me feel great about the NASDAQ, certainly not about the overall market, which again, in general, even the S&P, with very much a growth configuration to things. Now, that's just semiconductors. Let's look at the FANG stocks here. So I have this candle glance page. I'm going to just pop them up just a little bit so we can see them a little clearer. We have the FANG Plus Index, which comes from the New York Stock Exchange. It's sort of the FANG stocks, what I call the FANMAG names, but also some other names like Twitter and others that are grouped into that group of FANG and FANG-like stocks. Then I have the six, what I call the FANMAG stocks listed out here in order. Now, what's interesting about this is how many of these are above their 200-day moving average at the moment. Only one, it's Apple, right, which is currently around 165, the 200-day, not too far below, around 158, 7 points, about 5% below current levels. But all of the other six of these names are in a clear downtrend if you define downtrend as being above or below their 200-day moving average. Now, some of these have been in a clear downtrend for quite some time. Netflix and Meta platforms have been the outliers to the downside. These have been the weaker names that had big gaps down earlier this year that really haven't mounted a meaningful recovery, although Meta had tried to, certainly, but now has been sort of riding its 50-day moving average back down to the downside. Netflix, probably the worst of this bunch, testing all-time lows here, not all-time lows for the year for sure, retesting the March lows, similar to the SMH. Now, these other ones, I would argue, are pretty concerning. And the two charts that I would be watching this week, besides Netflix, are Microsoft and Alphabet. All three of these, Microsoft, Alphabet, Netflix, are very close to breaking to new lows for 2022. And again, I think the bull case for stocks as a whole would involve the FANG stocks looking a little better than this, certainly, and certainly not breaking down. It's hard for me to imagine the S&P, the NASDAQ mounting any sort of bullish configuration as these stocks are failing to hold support. So these hold support this week and bounce higher. I think there's a chance for a bullish argument here. These break down through support levels. It's around 2,500 on Alphabet, around 270 on Microsoft, and around 330 for Netflix. These are very close to signaling a pretty big breakdown. So this weakness that we've seen over the last week and a half on technology shares and related areas of the market, I think, have shown short-term weakness into potential support. And now the question is whether those support levels are able to hold or not. Let's continue on here. I just want to mention very quickly, a lot of stocks in the news, too many for us to really go through in detail. I did want to mention Twitter. Obviously, there's a whole news on Elon Musk, which was fun to catch up on. What's interesting when you have a big gap like this, right? Look at what happened from a technical perspective. We gapped higher right up to the 200-day moving average and then pulled back. We've now established a new level of support. Kind of forget about some of these earlier levels because we now have a new regime, right? Twitter is now at a new level of valuation given all the news flow that's come out related to Elon Musk, et cetera. So at this point, you have a new floor in that stock around 44, 44.50. That level holds, and this is starting to mount a nice constructive move. And that gap higher potentially is making a higher low, and we rotate higher. So the question now is, can we get back above the 200-day moving average and hold it? We get below those lows from last week, and all of a sudden this looks like a gap higher that is fizzled out and starting to rotate lower and test support. So I think right now you have a real clearly defined range for a chart like this and some key levels to pay attention to. If you're bullish on a stock like this, I would be watching the lower end of those recent lows, the upper end of this gap here to see if that's able to hold or not. But I'm concerned about its ability to hold given the weakness that we saw last week. Nice bounce higher, obviously up over 7% today. Now, I mentioned a number of names reporting earnings this week. This is Bank of America testing support. Nice move higher again today, up over 3% while the market was flat. But again, I'm concerned that that's coming off of a pretty weak level. Now, this is what's called a bullish engulfing pattern, a big move lower yesterday or on the end of last week, a move higher today where day two engulfs the range of day one. That's a short-term bullish signal using candlestick analysis. So coming off of this oversold condition at support, bullish engulfing pattern, wouldn't be surprised if we get a bit of a bounce here, but I'd be very much watching that level of 38 to see if that's able to hold or not. That's a level very much in play right now. Schwab, on the other hand, earnings today, but disappointed. You can see that gapping down right to support, closed right at the lows for March. So you can see with a lot of these charts, they've been stagnant, they've been sideways, showing some short-term weakness, but they're very close to breaking below support, where all of a sudden short-term weakness starts to materialize into more long-term weakness. Finally, two other names reporting earnings this week that have been relatively strong, and that's why I think they're important to watch. Freeport-McMoRan FCX reports earnings on Thursday. You also have Haliburton reporting earnings before the open tomorrow. These are stocks that are coming off of new all-time highs. The consistency of these uptrends has been impressive. Earnings can be a further catalyst to push these stocks to the upside, but the question is, can they hold that uptrend given the earnings coming up? We need to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes. Let's hit on kind of some of the key visuals that I think you should be paying attention to this week. We'll start off with chart of the S&P 500. Again, we didn't have a show end of last week to talk about some of these key levels when we usually do, but I would say, as we mentioned in our segment shifting stocks, looking at the S&P 500, I think a lot of individual charts are at key levels of support that I think have ramifications for the overall configuration of this market. There's been no doubt about the strength and value over the weakness and growth year to date. I think we're very close to seeing that continue. I could see a scenario where energy and materials continue to do well with strong earnings this week. You could see continued weakness on some of these growth areas of the market. I think the S&P is testing a very important support level. Breaking below 43.75 opens the way to 4,200, which I think would be the next potential level of support there. Chart number 2 is what I call the chart. A couple times a year, I'll work up a chart that I think hits on all the key metrics that I'm watching to sort of tell the story of this market. When I'm looking at the S&P right now, besides just the closing values of the S&P and see whether it's able to hold support, maybe put in a higher low here, I'm looking at 4 other measures of general risk on versus risk off. The advanced decline line for the New York Stock Exchange, which overall is remaining above March lows, but I'd love to see if that's able to hold or not. The small cap advanced decline line, by the way, has already broken below those lows last week. Consumer discretionary has been underperforming consumer staples. The S&P has been underperforming utilities, and the semiconductor ETF has been underperforming. All 3 of these are making or at new lows here over the last week. And I think watching those lines is an important way of measuring overall risk on versus risk off. Overall, this chart is telling me a clear signal of risk off at the moment. Finally, the energy sector. When we talk about the weakness in stocks, I will tell you, though, there are plenty of charts that are working just fine. The XLE looks fantastic. It's had a pretty good run. Is it due for a pullback? You could see the argument for that. Has a relative strength. The price action been very, very constructive? Absolutely. Would you expect a healthy pullback in a chart like that? Of course. But overall, in general, as a trend follower, I like following strength, and I'm seeing plenty of strength in energy and materials. Folks, that's our show for today. It's great to be back with you live here on the Final Bar. We'll be live all this week. We encourage you to check out StockChartsTV.com for all of our previous episodes. For StockCharts TV in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.